Gold up and stocks down, recapping a wild week in financial markets. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today I have 27 charts for you guys, walking you through every corner of global macroeconomics. Let's start with the Bitcoin chart. Over the last few weeks, we have seen Bitcoin consolidate around the $70,000 level. We view this as a healthy consolidation in the middle of a bull market, and we look for Bitcoin to continue to exhibit consolidation behavior before its next leg up. Now, of course, we are excited about the halving at the Bitcoin layer. This is Bitcoin's fourth halving event. This is when Bitcoin's supply schedule adjusts and the new amount of Bitcoin awarded to each miner is cut in half. So the new block reward will be 3 1/8 Bitcoin, but we are not explicitly expecting an immediate price reaction to the halving. Remember that the halving is a once in 4-year event, and miners have months before and after to plan. We do anticipate demand to outstrip supply in the coming months, but in terms of looking for an immediate price reaction from Bitcoin, we are not necessarily looking for that. The Bitcoin Layer is sponsored by River. Make sure to check out river.com today or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today. Now let's get to the biggest story of the week. It is by far the price action in gold. We have seen gold take a major leg up, breaking out above the $2,000 level, and now touching $2,400 in today's session. Our big question here is there a major shift going on in the global monetary scene? While we believe that there might be, it is too early to actually make this call. We want to wait for more evidence. But in the meantime, let's look at what is going on across financial markets, look at prices specifically, and try to theorize on why this move is happening. Now, in terms of the major global macroeconomic stories over the last decade, I can categorically say that Bitcoin is the major story. We have gold, of course, breaking out over the last couple weeks, but gold has been mostly range-bound, as you can see on this chart. For several years, gold actually hit $1,900 over a decade ago. So we look at gold and think that gold hasn't necessarily had a newsworthy price action breakout in well over a decade. We look at treasury yields also. Treasury yields are reaching new multi-year highs, but with 10-year yields at about 4.5%, this isn't uncharted territory for US Treasury yields. My point here is that the major story of the last decade in global macro is Bitcoin. It's not gold, and it's not US Treasury yields and the bond market. It is Bitcoin. But we do have to now listen to the price and what is going on in the gold market. The new all-time high in gold and the strength of this breakout now warrants a new analysis on what is going on in gold. Now, we have not been the type to make speculations and narrative projections on what is happening in the global monetary scene from a gold perspective, specifically with regard to China, China's gold contracts, China's oil purchases, and how China will use its massive gold stock to pay for energy. We believe that these are all components of the story. And now we believe that it is time to start vetting these ideas and understand ourselves better what is going on in gold. I bring up the comparison of Bitcoin being the biggest story in global macro over the last 10 years to what has happened here in gold in the last couple weeks because the story of the last 10 years with Bitcoin reaching these multi-trillion dollar levels, right? Bitcoin is now approaching the $2 trillion market cap. We're at about 1.5 trillion right now. Bitcoin approaching 2 trillion in market cap is suggesting something very specific about the financial system, which is that the financial system, which is a credit money system and a liability based system, is looking for asset money. That has been the narrative for gold, and it is the narrative for Bitcoin for sure. But with gold's underperformance relative to Bitcoin, and that is why we believe that now is the time to start focusing a little bit more on gold and what is happening with regard to China, the US dollar, and the global monetary system. Are we seeing a monetary reset? I would highly suggest that viewers go check out our $4,000 gold episode from earlier this week with Craig Shapiro. He lays out the case for what is happening in global currencies and gold, and I think you guys should go check that out. Another story here as gold is breaking out is that oil is breaking out. So here is a chart of Brent crude oil, and we see that oil is now above its descending trend line that had been in place for a couple of years. And with gold breaking out and oil breaking out, we do believe that something is going on around the world. Note that there are war headlines going on in the Middle East, and the Middle East war headlines are definitely contributing to the oil price action right now. Is it contributing to the gold price action? Potentially yes, and also potentially not. But the oil price for sure, in reaction to war headlines, we will continue to watch this space. Now, the second major story after the gold price breakout this week has been the strength in the dollar. So we're going to spend the next few charts talking about what's going on with dollar strength. So here on the screen, I have a multi-decade chart of the dollar. And you can see that currently with the dollar index above 104, and actually this morning it traded above 106, that dollar strength is starting to pick up. Now, I put this multi-decade chart on the screen to show you guys what we were talking about earlier this week with Craig Shapiro and the Plaza Accord of 1985. So I've pointed an arrow to the price action in the mid 80s of the dollar index. And what do you see? A dollar index well above 160. This is when the dollar was strengthening so quickly versus global currencies that countries had to get together and make an effort to weaken the dollar so as to make the global economy function more smoothly. Remember that when dollar debt is taken abroad, every incremental strengthening in the dollar will make the debt more punitive to pay back for the local currency borrower. Why? Because the local currency borrower is earning money in local currency. When the dollar strengthens, the debt payment actually goes up in price for the local borrower. So that is why dollar strength is a danger to the global economy. And more specifically, a strong dollar is a tight financial condition on the world's financial system because of this dollar debt stock. Then the dollar trended lower over the next several decades, but a couple years ago, the dollar has broken out above that multi-decade weakening trend, which we have seen. And remember to think about treasury yields. The chart on treasury yields looks somewhat similar to this, and that you had interest rates in the teens in the 80s. Those fell to near zero, and now yields are going back up. We have 5% yields, almost 5% yields across the curve, and a dollar that is strengthening on the back of that. Why does this happen? Because of interest rate parity. This is a concept in economics in which capital flows to the higher interest rate. So with US interest rates up, it will attract capital out of lower yielding currencies into the dollar in order to buy treasuries and other fixed income instruments that are yielding these higher yields. So a stronger dollar is in response to higher yields. Higher yields are a response to higher inflation. This is how it's all related. And I would suggest that viewers go subscribe to our free research publication twice a week. Free research on Bitcoin and global macroeconomics right to your inbox, thebitcoinlayer.com/subscribe. Now let's break down what's going on in the dollar versus specific currencies. First, let's look at the euro. What is happening in the euro? The euro has lost its trend line. This is a major theme today, guys. This is why I pulled 27 charts for you to show you trend lines are breaking down. My alarm bells are red right now because there is something going on in the financial markets. You guys know we're not a trading service. It's also not our job to make fantastical predictions. So thinking about what is going to be the future of the financial system in 5, 10 years and the shifts in the dollar, that is not necessarily our cup of tea. We are more price-driven analysts. And so when price starts to move, it does make us pay attention more. And I bring back Bitcoin because the price moves in Bitcoin over the last 10 years are telling the loudest story, or have been telling the loudest story up until now, which is that the dollar system is a dumpster fire. But looking more closely at the system, you see dollar strength versus other currencies. Now you see gold strength versus the dollar despite dollar strength. These are narratives now that are starting to confuse us and make us realize that something larger is happening right now. And it is our job to ask the questions instead of try to just say that we know what's happening and ascribe a narrative. So right now, without a doubt, we are in a more questioning zone and a curious mindset in terms of why are these moves happening. So take a look at the euro falling below its trend line to 1.06 right now, potentially heading down to parity with the dollar. The dollar is seeing strength as the yields in the US are remaining high versus the rest of the world. If the main driver of US inflation right now is fiscal dominance, which we will get to later in this video, if that is the main driver, then the US fiscal spending relative to the rest of the world should be the force that drives capital out of foreign currencies into the dollar. Why? Because fiscal spending higher creates higher inflation, creates higher US yields, creates dollar strength. And so the rest of the world, are they exercising fiscal dominance? Do we see large fiscal stimulus packages all around the world right now coming from Europe, coming from Canada, coming from Switzerland, coming from Australia and New Zealand? We do not. But the fiscal deficit overhang and continued trillion-dollar deficits in the US are likely the driver of the strong dollar at the moment. And so is Europe engaging in fiscal deficit spending to the trillion euro tune? No. So does the weakness in the euro surprise us? No, it does not. Okay, so that's what we are thinking about. That's why you have to have multiple components of the framework: FX, rates, commodities, and how these markets function with each other in order to understand better what's going on. That's our job. That's what we are trying to do here, is help you piece together those frameworks. Let's take a look at the dollar versus Asian currencies. So I have here a trailing 2-year chart on the Japanese yen and the Chinese yuan. The Chinese yuan in orange and the yen here in purple are showing you dollar strength. So as these lines go up, that is dollar strength versus these Asian currencies. The yen has now fallen to 153 versus the dollar. So that is 153 yen to buy $1. And that is weaker because only a year plus ago that was at 130. So you would only need 130 yen to buy $1. So the yen is weakening right now. The Japanese have shifted their monetary policy slightly, but it is their overall fiscal policy that we are watching to see if the Japanese economy can get inflation back in, drive yields higher in Japan, and then stabilize the currency. But right now, the relative strength of the dollar is due to the relative inflation in the US versus the rest of the world. We will talk much more closely about China here in a second, but I wanted to show you the relationship of China and Japan and these two currencies right now. It is a strong relationship. The Chinese currency is reacting to the Japanese currency and vice versa. We will continue to break this down. Make sure you are subscribed to this channel because next week we will have on Michael Cow to discuss Japanese and Chinese currencies versus the dollar, of course, gold versus the dollar, and what is happening in the Asian monetary landscape. Now, let's take a look at just the Japanese currency by itself. I have pointed an arrow to 1985 to show you the Plaza Accord. The Japanese currency was too strong at that point, and the dollar needed to weaken. And so what happened in this coordinated Plaza Accord? Dollar weakening, the yen strengthened. That is this chart going down as you need less Japanese yen to buy $1. And so the Japanese yen strengthened in the 80s. It continued to strengthen into the 90s. But now the Japanese currency is finally entering a secular weakening trend. This is something to watch, and we will look for continued weakness in the yen. Now let's look at the Chinese yuan. Now on this multi-decade chart of the Chinese currency, I have pointed to the 1994 Chinese yuan devaluation. Now, we have been talking about 1985 and the Plaza Accord in the mid-80s. This Chinese currency move has nothing to do with the 1985 Plaza Accord. So let's get that out of the way. This Chinese currency devaluation has more to do with China entering the WTO, the World Trade Organization, in the 90s, and the monetary policy decisions that China made in the 90s to peg its currency to the dollar. Now, readers and viewers will know that I have been focusing on the research of Russell Napier over the past few weeks, as Napier is suggesting that a major shift in Chinese monetary policy is underway. Now, what is that shift? Well, China has control right now over its interest rates, its price of money, the quantity of credit in the system, so the quantity of money, and it also has control over the exchange rate versus the dollar. But as China's current account and capital account surpluses begin to shrink for a variety of reasons, whether it's the trade war or whether it is a slowing global economy, the Chinese current and capital accounts declining suggest that the Chinese currency is potentially overvalued. And Napier is suggesting that President Xi Jinping in China will be engaging in a shift to let the Chinese yuan float versus the dollar, because right now it is in a highly managed currency peg versus the dollar, in which the PBOC, the People's Bank of China, is engaging in open market operations to keep that currency within its desired corridor. Once again, I personally have more questions than I do have answers on the Chinese currency, but that is the job of a researcher. And so I will continue to be reading and studying what is happening in China to try to bring answers to you all. And in this next chart, I have maybe potentially one of the answers as to what will happen to the Chinese currency and why. Now here we have the Chinese currency inverted on the scale. So now in the previous chart, I had the Chinese currency going up, meaning a dollar strengthening, because that's USD, CNY in that currency pair. So a number going up is a stronger dollar there. This chart, we have inverted it to show you in orange, this is a interest rate spread differential between China and the US. So let's focus on the orange line for a second. The orange line is a 3-month interbank rate differential between China and the US. So as you know, where has the US interest rate been over the last several months, specifically since July of 2023? It has been flat between 5.25% and 5.5%. That is where the Fed has its desired policy rate range. Rates are at about 5.125% in the United States. Now, where is the Chinese rate? Chinese rate has been lowered over the past several months. And so the difference between the Chinese rate and the US rate has increased in negative terms. So a negative 350 basis point spread here basically implies Chinese policy rates or Chinese interbank rates at about 2% with US rates at 5%. Now remember what we talked about earlier with interest rate parity. How do currencies move? Currencies move based off of capital flows. Capital flows look for the higher interest rate. And so, if the Chinese rate is declining relative to the US rate, what can we expect, all else being equal, using interest rate parity? We can expect dollar strength, because the dollar leaves Chinese currency investments yielding 2% and comes back in to buy US currency fixed income investments at 5.5%. And as it sells yuan and buys dollars, this should weaken the yuan and strengthen the dollar. Now let's bring the currency into this chart and look at the black line. Now remember, the previous chart, line up means dollar strength, and line up means yuan weakness. In this chart, it's inverted. So line up will mean yuan strength, and line down will mean Chinese yuan weakness. And so when this interest rate differential falls, we should expect Chinese yuan weakness. That's the relationship that you see here over the last 20 years, is that when the interest rate differential of these two currencies changes, the currency reacts. So when US rates go up relative to the Chinese yuan, the dollar strengthens, and vice versa. So right now, Chinese rates low, you should see the yuan weaken and the dollar strengthen. And you are not seeing the Chinese currency adjust to interest rate differentials. And that is the gap that you have here on the screen between the orange and black lines. The interest rate differential implies a weaker Chinese currency, but the Chinese currency hasn't moved in that direction. Why? Because the PBOC manages the currency. And right now, for one reason or the other, it is undesirable for the Chinese policymakers to let this currency depreciate according to interest rate parity. Why? We don't know. Does it have something to do with gold? Very likely, yes. So those are the questions we are going to be asking next week. Why is the Chinese currency not weakening if interest rate differentials are suggesting it should? And is gold going up the reason that the Chinese government is allowing itself not to let the Chinese currency slip? So those are the questions that we will be asking. Now, let's talk about US inflation, which has been the major driver of risk markets this week. We have seen stocks fall by about 3% since its all-time highs, so nothing too dramatic. But the price action in stocks has definitely been something that we have watched closely this week. We have seen definite weakness. We have seen bad earnings reports. We saw JP Morgan come out with a weak earnings report this morning. So the weakness in stocks is definitely something to watch. Stay tuned to the end of the video in which we show you the S&P chart and what's going on. Now, we had inflation this week. CPI came in the US at 3.5% year over year. Inflation is sticky above 3%. We've been saying that for several months at the Bitcoin layer. It came down from 9 to 3% in almost rapid fashion. And our call back then was that you shouldn't be worried about double-digit inflation. You shouldn't be worried about 9% inflation in this country. And so the disinflation trend is real. But it ran out of steam, and it ran out of steam last year. We are not seeing 2% inflation. We are seeing sticky 3 to 4% inflation. That has pushed back rate cuts. It has raised treasury yields, and it has hurt risk assets as that higher discount rate affects present value calculations. The heat map was popular when we brought it last time, so we're bringing you the updated inflation heat map here based off of the most recent US CPI. And what can you see? 4.7% year over year increase in the housing component of CPI. And that 4.7% increase in housing is the main driver. Remember that orange portion on the CPI chart. The housing contribution to inflation is the largest mover right now, and it is not coming down. Now, let's take a little bit of a closer look at some of the housing inflation metrics that we have access to. Now, the 4.7% housing component to inflation, it can be seen here on this next chart. In green, I have for you the CPI housing component. So that 4.7% you saw in the heat map, that is this 4.65% here on this chart. Now, the inflation aggregate at 3.5%, that is the black line that you see. So 3.5%, that's your year over year headline inflation number, and 4.7%, that is your housing component. So we can see that the shelter prices have not been able to come down to a 3% year over year increase. And they are stuck above 4%. And that is keeping the inflation headline numbers very sticky and high. Now, looking at the Zillow observed rent index, we saw that stabilize above 3% in the middle of 2023. So again, if you were looking for inflation to continue falling to 2 and 1 and 0%, you were missing the point here, because inflation started to stabilize months ago, and it cannot be seen any more clearly than on this next chart. ISM Manufacturing and ISM Services are the two PMI surveys that we love to use at the Bitcoin layer. They are the longest standing business survey metrics that we basically have around the global economy. And ISM Manufacturing prices paid component showed us all that inflation stopped falling toward the beginning of 2023, so well over a year ago. It bounced, and it was at a very low point. So expecting inflation to continue to fall would have been a sound approach. But when you started to see this trend higher, that was the tell that CPI is done falling. Now, ISM Manufacturing prices paid has trended higher for almost a year and a half. It is now back in expansion territory, and we see CPI responding as CPI lags this prices paid index. See that it increased way before CPI increased in 2020. It decreased before CPI decreased in 2022, and it started increasing again in 2023 before CPI started to increase again this year. Now, inflation doesn't necessarily appear to be heading to the 5 to 10% range again, but it also does not appear to be heading to the 0 to 2% range. And so this higher inflation is affecting monetary policy expectations, which are rippling through the rest of financial markets. So let's now look at the chain reaction of what happened after Tuesday's inflation print. Number one, the interest rate cut that was priced into the June meeting is now gone. We have been talking about interest rate cuts coming this summer from the Fed, but it looks like the one in June is no longer based off of this single data print. And what happens when the June cut gets priced out of the market now? The June cut gets priced out. So anybody that expected a second cut by July has to reduce that to a maximum of one cut. Anybody that expected 1% of cuts by December has to scale that back to maybe 50 or 75 basis points of cuts by the end of the year. Anybody that had bought 2-year yields on the expectation that we would get 1+% cuts over the next year has to sell those 2-year yields. And sell the 2-year note, which sends the yield higher. And so it is a chain reaction based off of one CPI data point. Hot inflation causes twos to sell off, yields to go up, and stocks to go down. And it happens because the June cut was no longer, and it made every other trader have to reposition their trade for the near-term expectation on the Fed policy rate. So on this chart, you have the first cut now is barely priced in before the election, and only 0.75% are priced in by the middle of next year. And remember, well over 1% of cuts were priced in by the end of this year, just a couple months ago. So the inflation not coming down repeatedly has removed these cut expectations, even though the Fed continues to tell us that they want to cut rates. So squaring that circle is also something that we are trying to do. We're trying to understand, why exactly is the Fed so committed to cutting interest rates when they do not see inflation coming back to 2%? Could it be because their new target on inflation is going to be 3%? Possibly, but that's not something we are explicitly expecting them to say. They might be putting out dialogue to suggest that that is the case. But one of the main reasons we believe that the Fed continues to say they will be cutting rates is their concern about financial stability. So it's not necessarily about getting inflation back to 2%, but making sure we don't have banking crises and a massive wave of defaults as higher interest rates affect profitability and the ability for certain economic projects to roll their debt forward. That trouble in rolling debt forward might come before inflation comes back down to 2%. So even though the Fed is telling us we will be victorious on inflation and that's why we will cut rates, you should not take their word for it. Because if they cut rates with inflation at 3.5%, you know they were lying. So that's why we need to be watching not just inflation, but what's going on in financial plumbing, financial stability. I would suggest people go check out our financial plumbing episode from earlier in the week, in which we talk about the difference between reserves and deposits and how deposits and reserves interact in the system. And that's a good segue to discuss what we are going to talk about toward the end of the video today, which is how long can the Fed continue to shrink its balance sheet? How long will reserves, and at the current stock, at the current level of reserves, how long will that be able to serve the functioning of the US economy? So we have a chart on that coming up soon. So back to this chain reaction. Number one, the Fed June cut gets taken out. Then number two, the rest of the year's cuts get reduced in the market. Then it translates into the Treasury curve. And so now you see 2-year yields rising back up toward the Fed funds rate. Now think about what we said to start the year with twos at about 4.25 to 4.5%. We said that if the Fed is not going to rush to cuts, then the policy rate becomes a magnet for the 2-year part of the curve. Now, we expected that twos priced at 4.5% would drag Fed funds down, but instead, Fed funds is dragging the 2-year yield back up above 5% or toward 5%, as basically this expectation of a lot of cuts is being removed. So twos, is it troubling to see twos at 5%? No, because the policy rate is at 5.33%. It simply means that the arbitrage opportunities to buying 2-year yields are gone in the eyes of the market. And the market would rather roll its interest rate overnight at 5.33% instead of lock in a 2-year yield below 5%. And of course, on the bottom pane here, we have the difference between Fed funds and the 2-year yield. Now you see that difference is shrinking back to zero. We still expect interest rate cuts. Remember, we think actually the Fed is lying when it says they'll cut because they'll be victorious on inflation. We do believe that they're going to cut. We do not think they're lying about that. We think they're lying about the reason they are going to cut, and it's financial stability. Now, let's go one more step in the chain reaction. 2-year yields going up, that should, especially the speed at which 2-year yields went up, it should affect the rest of the curve. Now, we had 10-year and 30-year auctions this week. They went very poorly in Treasury land. But remember, the auction results themselves are less concerning to us than the overall price action. And the price action this week was concerning. Treasury yields sold off, prices went down, and when yields went up, it affected the stock market really materially. So, I do want to mention one thing specifically though. Even though yields went up a lot on Tuesday and set off selling in the stock market, yields went down today here on Friday, yet stocks were still down. So it's the stock market going down is not only reacting to higher yields by themselves. It might be reacting to secularly higher inflation, and it might be reacting to overbought conditions in the risk markets on aggregate. But I don't want to suggest that stocks will only go down if yields go up. Stocks can go down with yields coming down in a flight to safety bid for treasuries. And that might have been at the margin what happened today in Friday's session, but we don't want to look at too much of the minutia. We do know that stocks struggled this week off of higher inflation and higher yields, but also make sure to note that yields can come down when stocks are coming down on a flight to safety bid. And if we are re-entering recession worries, notice how we haven't said the word recession so far today. If we are entering recession worries, that should negatively affect stocks, but it should positively affect treasuries in that treasuries will be bid, yields will fall when investors are locking in 4.5% yield in an environment in which they expect 2% inflation, not 4% inflation. So there are many things to factor in when we're thinking about the direction of treasury yields and that relationship with the stock market. But yes, in the micro, this week, higher inflation caused higher yields, which caused lower stocks. Now, let's look at treasury yields here in orange in the 10-year part of the curve. You see that they've trended higher off of below 4 all year long. They've trended higher. But where is the increase coming from? Is it coming from the green line and the break-even inflation number within the 10-year yield? No, it's mostly coming from the real yield here in purple, which has trended higher from about 1.75% to almost 2.25%. And real yields higher are the market telling the Treasury Department that we demand a higher and a higher premium above our own inflation expectations to hold this paper. So we will hold this paper for two reasons. Number one, to compensate for inflation. And number two, to compensate for the term that we are going to lend you the money. So in a way, that is how to think about term premium. It is the premium that you pay, or it's the premium that the government will give you to lend them money for that term. And so the real yield can be thought about as that compensation. And so real yields are higher. It suggests that investors need more compensation. It's not inflation by itself that's driving all of this move. Yes, break-even inflation has trended higher. You can see the green line has trended higher in 2024. But is it at 3%? Is it at 3.5%? No, it's between 2 and 3% for the last 5 years. So long-term inflation expectations are anchored between 2 and 3%. But that doesn't mean that treasury yields will also stay anchored. You have to factor in the real yield component, which is a compensation to the investor, which only the investor can decide. Because the market will sniff out inflation as it goes and comes based off of the data, but only the buyers and sellers can determine how much premium they demand to lend the government money for a long period of time. And so watching the 10-year and the 30-year part of the curve and how those react to the trillion-dollar deficits and large coupon supply increases coming from the Treasury Department, only time will tell on how much term premium is demanded by the market. Now here's a quick look at the yield curve. This is the 2-year, 10-year yield curve. We've been noticing how it's trying to steepen, and the yield curve can steepen as either one of these yields move. So if twos move much lower in yield, as interest rate cuts are being priced into the market, the curve will steepen. But as we see, twos have gone up in yield. So how does the curve steepen if twos are going up in yield? The 10-year yield goes up more than the 2-year yield. And right now, 2-year and 10-year are moving somewhat together, and the shape of the curve isn't drastically changing right now, but it is something we are watching. And if this number goes positive, it means we have more term premium, more compensation being demanded by the buyer to go out of 2-year into 10-year. Now here's the chart you guys have been waiting for. The S&P 500 has lost its trend line that it has held for all of 2024. And I just showed you the last couple months of bull trend in the stock market being broken last week, following through today, following through as stocks are now down about 3% from their all-time high. So is this a stock market crash? No, it's not even a correction yet. But trend lines matter and momentum matters. So as momentum has faltered, it does bring the opportunity for momentum to get going on the other side of the equation. So stocks showing weak closes to the day and closes to the week suggests sell programs going through, and that is what we should be watching here to see, okay, are there other concerns in the market besides this theme of fiscal dominance, which suggests that trillion-dollar deficits will goose nominal GDP on a continued basis and support all risk assets? Is that a blanket narrative that we can accept at its face value, or do we have to look at each individual price to tell us the truth? So if stocks are going up, that narrative is fine. But if stocks are going down, that narrative is gone. So that's what we will do. We will watch the stock market and we will allow for the stock market to tell us what is the expectation of the economy from the market. Speaking of nominal GDP, here is a chart of the United States GDP It is approaching $30 trillion. Now, why are debt to GDP ratios falling here in the United States? Is it because debt is falling? No, debt is rising. 10 trillion in deficits over the last 5 years, cumulative here at the US fiscal level. But GDP is rising faster than debt is. And I will show you that in a second, but this is the GDP number by itself. Now, in this next chart, I show you a 100-year history of US debt to GDP, and we are now above the levels from World War II in the 40s. But you do see at the tail end of this chart that US debt to GDP has actually fallen over the last couple years. Zooming in more closely here, this is the same chart just shown over the last 20-year time horizon. US debt to GDP above 125% during the pandemic. It has tapered off somewhat. It's not like it has come down a lot. But if we think about financial repression and the toolkit that governments have to alleviate debt burdens, the number one thing that a government can do is to increase inflation, which will increase nominal GDP, which will increase tax revenues without hiking tax rates. And those increased tax revenues can help to pay down for the debt. This next chart takes additional debt into the equation, and it adds private sector non-financial debt to the government's debt burden. And in that way, we have over 260% debt to GDP in the United States, but it has fallen from 300%. Why? Nominal GDP is skyrocketing as inflation remains sticky. Remember, nominal GDP is a non-inflation adjusted GDP. So nominal GDP includes all of those price increases in the economy. And so with nominal GDP higher, the overall debt to GDP in the non-financial sector has fallen materially. But it's not like we can call this any grand trend, multi-year trend yet. How does the US debt to GDP compare to the rest of the world and to China specifically? Now that 265% number, that is now in green here on this screen. And you can see that China has over 300% debt to GDP, way higher than the United States. And so when we think about problems in the world economy due to high debt stocks, we look at China and we think back to what we discussed earlier today. Is China heading for a devaluation of its currency? Is that deval based off of some debt dynamic? Is it based off of interest rate differentials? Or is it based off of something that we can't fully see clearly yet, like a major shift in monetary landscape, such as any gold settlement type of agreement between nations, oil for gold settlement between nations, or a revaluation lower of the Chinese yuan versus gold by letting gold appreciate versus the dollar and the Chinese currency keeping its peg to the dollar. Any one of these things is possible, and we will be bringing on experts in oil, gold, and Asian currencies consistently over the next couple months as we try to answer these questions ourselves. Now, can the Fed end quantitative tightening? That is a big question that we have. Look at the reserve balances held at the Federal Reserve Bank in orange. They are staying consistent above 3.5 trillion here over the last few months as the reverse repo facility has been drained and the Treasury has stopped stockpiling its cash coffers. And so as the Fed balance sheet shrinks, it basically can only come out of reserves now. And will reserves be able to fall below a certain threshold? We believe not. And this is why. It comes back down to nominal GDP and this next chart. Now in this next chart, I have Fed reserves as a percentage of GDP. And what has the Fed told us? The Fed tells us that it needs a certain amount of reserves in the system to make economic activity function properly. So if that number is 12%, let's just say it's 12%, where we are about right now. If nominal GDP keeps going up by a couple trillion a year, that means that the number of reserves in the system will have to go up just to make sure that there is enough money in the system at the banking level to allow interbank settlements and to allow Treasury to settle all of its new debt. Because on a one-for-one basis, when the Treasury increases its general account at the Fed, that money has to mathematically come out of either reserves or reverse repo. And that money, when it comes out of reverse repo, actually takes a trip through reserves before it makes itself available to the Treasury general account and for the government to spend that money. Long story short, we need reserves in the system, and we cannot see reserves fall below a certain threshold. So we will be watching the percentage of reserves versus GDP. And as GDP rises, we do expect the Fed to stop running down its balance sheet. Now, remember what the Fed is telling us, which is that it's almost victorious on inflation. If that is the case, and if the Fed, we can take the Fed's word for it, that the balance sheet and monetary policy interest rates are related as both sides of the same coin in monetary policy, we should expect them to continue QT as they have not hit the mark yet on inflation. Why? If inflation is still hot, keep rates high and shrink the balance sheet to try to create tight financial conditions. But we believe financial stability will be the main driver of Fed decisions. Therefore, we are looking at reserves as a percentage of GDP and how that will impact what the Fed decides to do on its balance sheet. Now, the Fed has suggested it will slow QT and it will eventually stop QT, but we do not think that they will be able to land the QT plane as smoothly as they think. We will be watching reserves as a percentage of GDP. We will also be watching smaller banks to see what is happening there. Now, I have two final charts. We mentioned recession, but we also showed you how well the economy is doing this week. ISM manufacturing, ISM services, and inflation are all suggesting that the economy is running hot. But we can't forget that high interest rates are punitive to borrowers, and so default waves will happen whether we like it or not. So, looking closer at regional Fed data and regional economic data, we cannot necessarily find a ton of broad economic strength. So I have regional Fed surveys for you. This is Virginia, Texas, New York, and Philadelphia. All of these regional surveys are showing an economy that really isn't doing that great. And it's important to show you these surveys so that we don't get confused and just think that we are in a no recession zone. No, recession is still at play because the economy is subject to these higher interest rates. Remember back to our episode over the last couple weeks where we compared fiscal dominance to monetary dominance. Fiscal dominance is clearly winning as deficits are causing high inflation. High inflation causing high interest rates causing more interest income going back into the economy via the interest income channel. But what else do you have? You have high consumer borrowing. And high consumer borrowing is going to be affected by high interest rates. That should slow down the economy on the other side. So which of these two will win in the balance? That is, again, one of the major themes that we will be watching this year. So when we see regional surveys exhibiting basically a slowdown or no growth, it shouldn't surprise us. The final regional survey I have here is the Chicago PMI. Now notice how in orange we have ISM manufacturing back above 50 and back into expansion. We actually saw Chicago PMI go above 55 late last year to suggest the economy was back on strong footing, but all of a sudden it has dipped. So you see a divergence here over the last couple months on ISM manufacturing and Chicago PMI. Now, we prefer, of course, the ISM manufacturing as a more robust data series and not necessarily a regional one, but that doesn't mean we should ignore PMI surveys that have had a long life and have had a strong correlation to ISM. So the weakness in Chicago PMI is something that raises a red flag for us in that maybe the ISM data isn't all it's cracked up to be or is lagging to other regional surveys that suggest a slowdown in the economy is actually with us again. Thank you for sticking with us today at the Bitcoin Layer. Make sure to subscribe to our free research letter twice a week at thebitcoinlayer.com/subscribe. Subscribe to this channel, and we'll catch you guys next time. Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.